Welcome back to AZ Trading, everybody. Hope you're doing well. And in this video, I'll be going over how I use the ICT 2022 mentorship strategy, as well as some adjustments that I've made that has actually improved this already great strategy, which is how we managed to capture this bullish move on the Dow Jones, where we've sniped the literal bottom of that swing low, and we've taken a few partials along the way, and we managed to capture a huge chunk of a move spanning around 360 points. And these arrows aren't fake and drawn onto my chart. When I hover over them, you can see the actual orders. So long story short, the strategy in question is all based on liquidity, which refers to where the money is in the marketplace. So where the orders are, the stop losses, the buy stops, the sell stops, etc. And we know that when there's a range in price, there's always liquidity above and below swing highs and swing lows. And when there are equal highs and equal lows, that just means there's more liquidity resting at that area. And the higher the time frame you go, the more liquidity rests at those swings. So to summarize this strategy very briefly, when one side of the market is taken, so the liquidity below these equal lows is taken. This is the first part. The second part is waiting for a shift in structure. So there was a bearish leg in price, and then we broke a swing high, meaning we are short-term bullish. And after this short-term bullish leg, once we've broken a swing high, we wait for a retracement. And as soon as price retraces into a fair price, whether it could be an order block in here, could be a gap in here, or in a discount with a fib, this is when the strategy tells us to enter. And with our stop loss at a different swing low and our target at this area of liquidity above these equal highs, this right here is basically the ICT mentorship strategy in a nutshell. And if you've seen any of my previous videos, you know that the way we delineate this strategy is by calling it the RMR pattern, which breaks it into 3 simple and separate steps that makes it very easy to spot this strategy. So like we said, the very first leg down here, as price reached this area of liquidity, this would be called the raid. And as price broke structure and became short-term bullish, this would be the market shift. And finally, as we wait for price to retrace for our entry, this is what we call the return area. And so once price reaches that return area, that's where we can place our buy. So I'll just show you guys a few backtesting examples that actually led to capturing this trade on the Dow, just to show you guys this pattern happening in actual price and not just me drawing lines. So we're here on the Nasdaq on a 15-minute chart, and I'll just show you guys a few RMR examples. So it's very easy to spot. So first we have some relative equal lows here. When price breaks through, that's the raid. And I've just drawn this diagram here. So this little raid down here is this raid leg over here. And next we look for that market structure shift. So a swing high to be broken, and we see over here a swing high was broken immediately after, so this is that shift. And finally the return, so we wait for price to retrace into this area. And if we look at the chart, we have this big gap over here. When price retraces into this area, this is the return area. So when price retraces into that return area, that's where we look to place our buy with our stop loss at the bottom of that raid. And then we have our objective above, which are those relative equal highs up here. And you can see that this price example here looks very similar to this very generic RMR representation. So this is a 15-minute RMR example. And now I'm just going to zoom into the 1-minute chart, and I'll show you guys a 1-minute RMR that happened within here that led us to capture that bullish move on the Dow. So I've zoomed into a 1-minute chart, and you can see this is that 15-minute return area. And on the 1-minute chart, let's look for another RMR. I'll just go through this one a bit quicker. So first we have a swing low that was broken. So this would be the raid. Then we look for a market structure shift. So breaking a swing high. So this swing high was broken. This is the market shift. And finally, we look for a return. So we have a gap within here, and we have a large order block within here. These are both return areas. And so once price is up here, we don't want to FOMO and we don't want to buy up here. We don't want to buy up here and target those equal highs, because we're getting a very expensive price up here. And what does the strategy say? It says to wait for that return area for price to retrace into this area before we start to place our buy orders. And so this way we'd be getting a much cheaper price. But if you guys were really paying attention, let me just clean up this chart. You can see that we have this raid down here, but the market structure shift actually happened before this swing high. So if we look at price down here, price is making lower lows and lower highs until this area right here. So right over here, this swing high, as soon as that one was broken, this would be the market structure shift over here. So you can see that both of these are market structure shifts since they broke a swing high. However, this is the very first indication of that market structure shift. And so once again, after that shift, we look for a return area, and underneath we see this 1-minute order block. So once again, when price retraces into that return area, that's where we can place our long orders. All right, now that we've covered the strategy and summarized it into 3 simple steps, I'm going to go over how we can actually improve this strategy by using something called relative strength. Now, what relative strength means is when you have a buy opportunity or a buy forming on whatever you like to trade, let's just say it's the NASDAQ that you like to trade, relative strength means whatever is closely correlated with the NASDAQ. So we have S&P and the Dow, so the US indices. This just means if we want to place a long order, we want to find which of those three is the strongest, and that's where we're going to place that long order. And this doesn't just work with indices. If you're a Forex trader, for example, you trade the Euro USD, you can also use relative strength to help you decide which to trade between the Euro, the pound, the Aussie dollar, or the New Zealand dollar. So back onto this NASDAQ example, if we're using the ICT strategy or the RMR strategy, this would be where our entry is at 9.59. And you can see that we would have captured a pretty decent move. However, let's just use relative strength and I'll show you guys the benefits. So in order to find which of the indices is the strongest, I'm just going to draw a fib from the bottom of this swing low to the top of this swing high. And the whole purpose of this fib is to show how deep price retraced into. And the deeper price retraces, the weaker that indice is. And if price has a very shallow retracement, then we can tell that that indice would be much stronger. So here on the NASDAQ, price retraced just above that 79% level. I've moved on to the S&P. I'll draw that same fib and we can see that price has retraced above that 79% level, meaning that the S&P is currently stronger than the NASDAQ. And I'll just go on to the Dow finally, same fib once again, and we can see that price has retraced not even to that 62% level. So to recap, Dow retraced above 62, S&P retraced below 62, and NASDAQ retraced almost to 79. So just from this very quick relative strength analysis, we were able to tell that the NASDAQ is actually the weakest, and the Dow, the US 30, is actually the strongest. So this entry here on the NASDAQ at 9.59, instead of placing our buy orders here on the Dow, if I zoom into my entry, you can see that our order was placed exactly at 9.59. And that's how I use the ICT mentorship strategy combined with a relative strength analysis. And overall, you can see that as a result, the Dow ended up pumping much more strongly. Even during this consolidation, price was bullish. Whereas if we long the NASDAQ or the S&P, you can see that during this consolidation, price is not obviously bullish. So being able to pick and choose which indice was the strongest allowed us to capture this larger bullish move. I won't cover too many topics in this video, like how to form a daily bias and how to use a sentiment analysis, since that video would just go over time and I don't want this video to be too long. But I'll just mention very quickly about my objectives. So for my objectives over here, these ones are pretty self-explanatory. When price reached that swing high, I took off a partial, and when price reached this swing high, I took off a partial. But this final partial over here on the S&P, we've got some relative equal highs, and those highs were taken at around 1410. And here on the NASDAQ, once again, we've got some relative equal highs. Those highs were also taken around 1410, 1415-ish. And on the Dow, we can see we don't really have those equal highs over there. So this objective here was taken off based on the NASDAQ and the S&P. So you can see it was taken off at 1410. Alright guys, that'll be it for this video. Hope you learned something new, and if you did, leave a like and subscribe. It makes me very happy. And if you've got any questions, leave them down below. I'll get back to every single one of you. But until next time, take care everyone. Peace.